Warren Buffett serves as the chairman of the board for Berkshire Hathaway Corporation, and Charlie Munger serves as vice chairman. He was born and raised in the same town as the well-known financier Warren Buffett. On January 1, 1924, he was born in Omaha, Nebraska. When he was younger, he worked at the grocery store owned by Buffett's grandfather. After 10 hours of labor, he was paid $2 in the United States. At that time, the two people who are now considered to be the best of friends and business partners had not yet met. Today, we will discuss Charlie Munger investment strategy that can work in a recession. Charlie didn't always like making investments. He went to Caltech to learn how to be a meteorologist during the Second World War. He went to Harvard Law School after that and eventually opened his own law firm. Investors and managers of investments got advice from the law firm. This was his first time investing money. In 1965, Munger stopped being a lawyer. After he quit his family business, he went to work for Warren Buffett at Berkshire Hathaway. In 1978, he became the vice chairman of the company. Charlie Munger and his way of investing. We are always looking for ways to make money quickly. But Charlie's great work isn't the result of a magic formula, nor from a system that comes from business school or a model from a book. It comes from his philosophy, which he made by always looking for better ways to think. It comes from how carefully and well his multidisciplinary research model was put together. The ways that Charlie Munger and Warren Buffett invest are a lot alike, but Munger focuses on one thing in particular: how people act. He has spent his whole life learning about the best ideas in many different fields. He didn't just get lucky or do something right. He kept trying to find answers to different patterns, and it paid off when he realized how flawed people are. The effect of Lalalapalooza. This effect is based on the fact that people have many natural biases and tendencies. Together, they can change and affect how we act. It's called the Lalalapalooza Effect when several of these biases work together to make us do something. In his 1995 Harvard speech called The Psychology of Human Misjudgment, Charlie Munger came up with the term Lalalapalooza Effect. He talked about many reasons why people make bad decisions. He used open call auctions as an example to explain the same thing. When people at an open auction are pushed to bid, they tend to do one of four things. 1. Reciprocity. Reciprocity is a social pattern where people respond to a good deed with another good deed. So, the people who went to the auction felt like they should buy something just because they were invited. 2. Consistency. It means the way someone thinks when they don't want to break a chain. For example, if the person is known for liking a certain type of thing or product, they feel like they have to buy it. 3. Commitment tendency. If someone is bidding in an outcry auction, they are likely to keep doing it just because they started. 4. Social proof. People often try to find a way to fit in with a group to feel like they belong. Social proof is the tendency for someone to do something just because their friends are doing the same thing. Why is it important for investors to know about the Lalalapalooza Effect? Munger says that the Lalalapalooza Effect can lead to herd mentality in the stock market. How one investor acts can affect how other investors act. For instance, a certain piece of news can cause millions of investors to buy one sector and sell another. This could make the market very unstable. This is like the snowball effect, but it has to do with how people think. The worst thing an investor can do is follow the crowd. Everyone is out trying to sell something after all. Who is really making money? No one. People tend to follow other people because of the herd impulse. Investors worry that others know more than they do when the market goes up or down. So, investors have a strong urge to do what everyone else is doing. In the late 1990s, investors often thought that any sudden drop in prices was a chance to buy. But buying when prices go down isn't a sure way to make money. Even if a stock is cheaper than it was before, that doesn't mean you should buy it. The rise and fall of the market are caused by many different things. If you only use the buy on dip strategy, you could lose money. Both on a small and a large scale, these kinds of mistakes are common. Munger thinks that it is smart to keep an eye on psychological factors for this reason. Charlie's investment strategy is mostly about what to buy and not so much about when to sell. He says one way to do this is to write down what you read and keep those notes for future use. When inflation is high and interest rates are climbing sharply, it can be very challenging for investors to make money. Keeping a lot of cash on hand is not a wise decision when inflation is taking place. Worth of your dollars, but investing in them is also a bad idea because the Federal Reserve is putting the brakes on consumer spending as well as firms' ability to borrow money and pay back debt, which means that many businesses are having a hard time making ends meet. Value investing never dies. Another individual who places their money on this type of investment is Warren Buffett, who is not only a partner, but also a close friend of Charlie Munger. Buffett has $119.9 billion. Both are well known for being two of the most successful value investors of our time period. Investing based on value is a technique that looks for stocks that are either undervalued in the market or that have sold for a price that is lower than their fair or inherent value. Don't be the gambler. An intelligent way to navigate the current stock market climate might be to take a patient approach. This can mean holding off on making a purchase until there are more desirable opportunities than there are right now. If the current bull market continues, this can cause the investor to get frustrated in the short term. They can lose out on future stock price increases while their colleagues continue to enjoy steadily rising portfolio values. However, over time, being patient may enable them to access far more advantageous stock prices, which translate into a more effective deployment of resources. Charlie Munger has in fact before talked about how crucial patience is when managing a portfolio. The world is filled with foolish gamblers, he claimed, and they won't do as well as the patient investors. Naturally, it is challenging to put the events in the stock market today into context. For instance, while a market is in motion, it is easy to feel as though it will continue for a very long period. Any investor may find it more difficult to see the larger picture while they are experiencing strong emotions. However, historically, a bull market has produced gains of about 110% and lasted about 3 years on average. Despite the fact that there have been 26 bear markets since 1928, which puts the present bull market behind both of those numbers, it is clear that patient investors who are willing to wait for better purchasing chances will likely be rewarded many times over in their lifetime. It might be simpler to maintain a patient approach to a strategy that entails purchasing overvalued shares in the belief that they would increase even further if one is constantly reminded of such factors. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.